Hello and welcome back to Money Never Sleeps. My name is Mac from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-973-3627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. When the Federal Reserve recently announced a rate cut of 50 basis points to 4.75 to 5%, it set off a flurry of chattering within the financial news sector. Is this good news or bad news? What does it mean for retirees? What does it mean for home buyers? All excellent questions, and during today's show, we're going to discuss what the rate cut means for the average American. A CNBC article, the Federal Reserve just cut interest rates by a half point. Here's what that means for your wallet. Nicely details the situation. Also, I think that may be the longest headline for any article we've ever cited on our show. We should be making an important distinction. The federal rate, which is determined by the U.S. Central Bank, is the interest rate at which banks may borrow or lend to each other overnight. But that's not the rate the everyday person will pay. However, the Fed's recent move will affect the borrowing and savings rates Americans see every day. This fall's rate cut, the article notes, came at just the right time for many people. Because of a series of rate increases beginning in March of 2022, the central bank's benchmark reached its highest point in 22 years. With that, consumer borrowing costs went through the roof, putting many people under increased financial pressure. So rates going down is, in many ways, a net positive for the average American. However, one rate cut, even a sizable one, isn't going to solve everything all at once. Ultimately, this fall's rate cut isn't likely to produce significant relief for overall household budgets. What will help many people is if this current rate cut leads to a series of additional rate cuts in the coming months. The article also notes that generally, interest rate cuts lead to winners and losers. Typically, lower rates are better for borrowers and are less advantageous for lenders and savers. We're going to get into what the rate cut means for specific categories in just a moment. But my first recommendation is that if you're curious about what the rate means for your current financial strategy, I'd urge you to reach out to your financial services professional to schedule a check-in. Now let's look at those categories I mentioned a moment ago, the first of which is credit cards. Because most credit cards have a variable rate, there's a straight line from the interest rate to your favorite credit card. Because of the central bank's rate increases that began in March 2022, the average credit card rate jumped from about 16.3% to the more than 20% that many people are seeing right now, a rate that's close to an all-time high. In the months ahead, annual percentage rates will likely begin coming down. However, it will mean they're simply dropping slightly from their recent very high levels. The article predicts that APRS will likely hover around 19% during at least the next several months. In a nice analogy, the article suggests that interest rates took the elevator up, but they'll be taking the stairs back down. This means that it's important to continue prioritizing paying down high-cost credit card debt as quickly as possible, because the rate isn't expected to drop quickly enough to provide you with much relief. Relatedly, you may want to discuss taking out a new card that offers a 0% balance transfer with your financial services professional. The article next highlights mortgage rates, something that's an area of great interest for many people. Though 15 and 30-year mortgage rates are fixed and tied to Treasury yields in the broader economy, anyone who's shopped for a new home in the last 2 years has seen a steep decline in purchasing power due at least in part to the Fed's policy choices. Fortunately, rates are already much lower than they were just a few months ago. Currently, the average rate for a 30-year fixed-rate mortgage is about 6.3%, according to the article. The article spoke to a LendingTree economist who anticipates that mortgage rates will hover in the range of 6 to 6.5% during the next few months, with a decent shot that they'll fall slightly below 6%. However, this expert threw some cold water on the news by predicting that rates will never fall back to their pre-pandemic numbers. All in all, mortgage rates are still quite high, when compared to where they were just a decade ago, and home prices also remain very high in many parts of the country, and that means many people will remain priced out of the housing market for the foreseeable future. The picture for auto loans is also full of nuance. Though auto loans are fixed, higher sticker prices and higher borrowing costs have hit many auto buyers hard. Right now, the average rate on a 5-year auto loan is more than 7%, a significant jump from the 4% most people were seeing when the Fed first began increasing rates, according to the article. But there is some good news. Fed rate cuts will likely drop the rate below 7%, helping to take some of the bite out of auto shopping for many people. Competition between lenders and more buying incentives out in the marketplace should also help matters. Many Americans have reported holding off on new wheels until interest rates drop or when attractive incentives return. And while one rate cut likely won't send everyone back to the dealership, it should help to some degree and may become even more potent should additional rate cuts occur in 2025. The rate drop will also influence student loans. While federal student loan rates are fixed, people with those loans won't be immediately impacted by the most recent rate cut. But the story is different if you have private student loans, which can have either a fixed rate or a variable rate that's tied to the Treasury or other rates. Once the Fed starts cutting interest rates, those with variable interest loans should see their rates come down over a 1 or 3 month period, depending on the loan's benchmark language. Additionally, people with variable rate private loans may be able to refinance into a cheaper fixed rate loan. Be aware, though, that refinancing a federal loan into a private student loan means you'll sacrifice safety nets that federal loans provide, like deferments, forbearances, income-driven repayments, and loan forgiveness and discharge opportunities. And extending the term of the loan means you'll likely pay more interest on the balance in the long run. The article also details what the recent cut may mean for savings rates. While the central bank itself doesn't influence deposit rates, yields are often correlated to changes in the target federal funds rate. Because of this decade's Fed rate hikes, top-yielding online savings account rates have made big jumps and are currently paying more than 5%, the most many savers have earned in almost 2 decades, and a large bump from the 1% most savers were seeing in 2022. Unfortunately, if you haven't already opened a high-yield savings account or locked in a certificate of deposit, you've probably already missed out on peak rates. But at the same time, the article notes, yields aren't going to crater immediately after the Fed cuts rates. So, again, though that 5% rate is likely done, at least for the time being, it may still be worthwhile to meet with your financial services professional to discuss the potential benefit of adding a high-yield savings account to your strategy before rates fall even further. If you have any questions about the new generation retirement system, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.